Fitch, which is a top-notch global rating firm, recently downgraded United States credit rating. So what does the downgrade mean? How it's gonna affect the markets and everything? Let's understand all that in today's ETMarkets Decoder video. I'm Neha Vashisht from ETMarkets. Let's begin. So first of all, let's start with top things you need to know about this downgrade. Fitch downgraded US debt rating to AA+ from AAA. This step has been taken due to expected fiscal deterioration over the next 3 years, a high and growing government debt burden, and erosion of governance. However, this downgrade has been looked down upon by US Treasury Secretary Janet Yellen, who called the rating downgrade arbitrary and outdated. Now let's discuss about the possible impact. Before we talk about the stress around this topic, I want to highlight that this is not the first time that the rating of US has been downgraded. Back in 2011, S&P did the same and took down the rating a notch, making it AA+, and it led to steep stock market declines and rising bond yields were observed. So naturally, there is a tension in the markets. However, according to many analysts, the Fitch rating downgrade might not impact debt, currency and commodity markets that much this time. As per a report by Tata Mutual Fund, there could be some correction in the equity markets globally due to risk-off sentiment, but there will be minimal impact on bond yields, currency and commodity markets. Additionally, this recent rating downgrade could lead to a rise in US Treasury yields and a decline in risk assets. When it comes to dollar and gold, it could strengthen as investors shift their assets towards safer options. However, there is no denying that this could also weigh on emerging markets assets due to a rise in US yields. Now you must be wondering, what are the reasons behind this Fitch downgrade? Number one, rising general government deficits. The GG deficit is expected to rise to 6.3% of GDP in 2023, reflecting cyclically weaker federal revenues, new spending initiatives and a higher interest burden. State and local governments in the US are expected to run an overall deficit of 0.6% of the total GDP. Number two, general government debt to rise. The GG debt to GDP ratio is projected to rise to 118.4% by 2025. The debt ratio is over 2.5 times higher than the AAA median of 39.3% of GDP and AA median of 44.7% of GDP. Number three, erosion of governance. There has been a steady deterioration in the standards of governance over the last 20 years, including on fiscal and debt matters. The repeated debt limit, political standoffs, and last-minute resolutions have eroded confidence in fiscal management. In addition, the US government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. Number four, recession. Tighter credit conditions, weakening business investment, and a slowdown in consumption will push the US economy into mild recession in 4Q23 and 1Q24, according to Fitch projections. The agency sees US annual real GDP growth slowing to 1.2% this year from 2.1% in 2022 and overall growth of just 0.5% in 2024. High job vacancies and low labor participation rate than pre-pandemic levels could negatively affect medium-term potential growth. Lastly, let's talk about the expert opinion on this. Abhishek Banerjee, CEO of Lotus Dew, told ETMarkets, "As investors, we have to watch. We cannot react right away. There is a need to watch out for US 10-year Treasury yields, crude and USD INR moves before we jump to conclusions." Adding to US credit ratings being downgraded, he added, S&P was responsible for the first ever US debt downgrade to subprime in 2011. Subsequently, S&P was embroiled in an SEC investigation, which they eventually settled in 2013. Even back in 2011, political brinkmanship around the debt ceiling got everyone talking about a possible default, just like now. Fast forward to 2023, currently Moody's is the only rating agency that still rates US debt as prime, while S&P and Fitch rate it as subprime. This issue will be sold by large pension funds, which by law are required to own prime government bonds only. Well, that was all about the US credit ratings. If you like this video, comment and let us know.